Hi, everyone. Welcome to today's monthly analyst call. We will get started as people start streaming in. Thank you all for attending. This is the June edition, and it's the last one before we take a brief pause for the summer. We will be back in September. So we're joined here by the CeFi research team. We have Desi and Adam, and we have Anastasia, who will actually be taking over the team starting next month. And we're really excited to talk to you about ETFs, among other research crypto trends today. So in case you are new to this call, a little bit about CeFi. CeFi is a crypto data provider. We have been around since 2014, providing all types of market data. We have 6 core services. The first is market data. This is tick level and aggregated trades and order books from more than 100 exchanges. We also offer DeFi and blockchain data. We have analytics. We have rates and indices. And those are our data offerings. And then we have research and data visualization for the analysts that are here. And so in case you are interested in our data, don't hesitate to reach out for an enterprise consultation. Otherwise, some of the latest CeFi updates. We just launched our Q2 crypto exchange ranking. I will be presenting that later in this call. But also for those who are impacted by the upcoming MiCA legislation, which goes into effect very soon, we have a data guide that will help you decode this legislation. And finally, for all the analysts and researchers or journalists on this call, if you have not yet checked out our data visualization tool, Data Plus, be sure to do that from our website. This lets you explore for free trade and order book data for Bitcoin and ETH. It has more than 25 unique charts, and you can mix and match from more than 30 different exchanges. So a very good tool for researchers here with a lot of coverage enabling deep liquidity analysis. So without further ado, I'm going to pass the mic to Adam, who will talk about crypto ETFs.
Great. Thanks, Clara. So I guess we'll dive in, and first off, just kind of an overview of Bitcoin ETFs and net flows. So what you have here in this chart is net inflows of the new 9 ETFs that launched. So excluding Grayscale, which was already a closed-ended trust beforehand and just converted. So it held Bitcoin before. So this is just looking at BlackRock, Fidelity, ARK, Bitwise, VanEck, and the rest of the newly launched funds, which have, kind of rapidly accumulated Bitcoin. If you look at this chart, there's over 425,000 Bitcoin held by these new funds and net flows into these new funds. And I mean, Grayscale converted with 625 or 630,000 Bitcoin in January. So it's really kind of impressive the speed at which these funds have managed to accumulate Bitcoin. There was a slight kind of lull between April and May, and there was a drop off in May, which we'll see in the next chart. So this next chart looks specifically at BlackRock, which had 67 straight days of inflows, which ranked in, I think, the top 10 ETF launches of all time. The record is about 150 days of trading days of inflows. So it's really impressive, but it saw some outflows in May. This kind of coincided with a dip in Bitcoin's price about 2 weeks after the halving, but those inflows didn't last for too long. And BlackRock actually, as you can see in the chart, from the middle of May, started seeing inflows again. And then in June, it started clocking some of its best days since, the end of March. And in the next chart, you'll see then that demand for BlackRock's Bitcoin ETF surpassed Grayscale's GBTC. It took just 96 trading days. So like Grayscale started off with over 600,000 Bitcoin, 26 billion in assets under management, and BlackRock has already eclipsed that. Partly that can be probably attributed to Grayscale's large fee of 1.5%. Versus BlackRock's, I think they launched with a fee waiver for the first 6 months or on the first 1 billion assets under management. But it's still quite impressive that BlackRock has managed to eclipse Grayscale in that period of time. And it's also interesting to note that a lot of those holders that have kind of flocked to BlackRock were institutional demand from hedge funds and the likes of Millennium and D. Shaw and Elliott Management, some of the biggest funds in the world, announced they'd help Bitcoin ETFs at the end of March. So those filings came out. They were a lagging indicator though, because the filings obviously are dated 31st of March, but it's still interesting to see who was holding these funds. And BlackRock had over 450 institutional investors, which is massive. So then in the next chart, we look at what that kind of buzz of that launch had, what the effect of that was. So obviously Brazil launched Bitcoin ETFs, as you can see, in 2021. We talked about that a bit more in our recent LATAM report. But really, when the US launched spot Bitcoin ETFs in January, it kind of kicked off a chain reaction of demand. Hong Kong then launched in April. These had previously been approved prior to the US funds, but they went live in April. The demand has been a little bit mixed. There's been some outflows, but they have accumulated some volume. And they were followed then a few weeks later by LSE launching Bitcoin ETFs. But these ones in London are specifically for private investors, so retail doesn't have access to them yet. But now more ETFs are going to be coming online in Australia this week, a sort of feeder fund where investors can get access to VanEck's HODL through the Australian Stock Exchange. And there's also some other applications there from local issuers that are hoping to bring spot Bitcoin ETFs to Australia. And then that demand for ETFs has gone beyond Ethereum, has gone beyond Bitcoin, as we see. And Ethereum was eventually approved for spot ETFs at the end of May. So as we can see in the next chart, when this happened, it was a bit of a surprise for the market. Most people, and I think a lot of analysts, had kind of expected this to be denied. I think I even wrote something quite bearish the day it was came out that it was going to be approved. So the market was kind of shocked, and relative to Bitcoin started outperforming. So as you can see here, the ETH Bitcoin ratio, Ethereum was massively outperforming Bitcoin at the end of May and into the beginning of June. So the ratio went up above 0.055. It's remained elevated. It's around 0.52 at the moment, but Ethereum is still massively kind of riding that wave. But importantly, and what I'll discuss in the next chart now, is these approvals on the 24th of May. Unlike Bitcoin, it didn't start trading the next day. But what it was basically the journey from September when when VanEck and 21 shares, they fall through the CBOE for 19B4, which is basically a real change to allow these funds to trade. But what has to happen next now is VanEck and 21 shares, ARK has since pulled out, have to file S1 filings with the SEC, which gives them approval. There shouldn't be an issue with that, and Gary Gensler has said at a Senate hearing last week, that he expects those to be approved over the summer months or by September. So we can see the timeline there. These were approved they filed in September. Futures ETFs went live in between then, but just didn't really have the demand. It's all about spot, really, is what people want. So people will be keeping an eye on when that will come over the summer months. And that's it for ETFs.
Thank you, Adam. So the second topic of the day is also a very hot topic, since we're 10 days ahead of MiCA's regulation first implementation phase concerning stablecoins usage by Europeans. And to address that, it's worth spending some time to understand which stablecoins are the most used by Europeans. Our first intuition could be that Europeans are actually using euro-backed stablecoins. However, when looking at the volume of euro-backed stablecoins through that chart, taken all together, including those issued by Tether, by Stasis, by Societe Generale, Anchored, and more, we actually can see that euro stablecoins are indeed seeing a slow increase in volume since the beginning of the year, but still those stablecoins do not represent much relative to USD-backed stablecoins. It's even more surprising, so the next chart, to see that euro-backed stablecoins have actually very low success with respect to the euro itself used for trading cryptocurrencies on exchanges, since, as you can see on this chart, just 1% of euro-denominated trades are done with stablecoins. But then, if Europeans are not using the stablecoin that are backed by their own currency, then does it mean that they're using USD-backed stablecoins like USDT instead? Actually, it seems to be the case. So next chart, please. When looking at the settled volume on crypto exchanges against the euro, the pair USDT euro on Kraken is actually the first one by far. And this means that Europeans, who are the only ones having access to those euro pairs, are actually very interested in holding or trading USDT on those exchanges rather than euro stablecoins. And this is quite concerning because with MiCA coming soon, a lot of exchanges are going to adapt their stablecoin offering and ultimately will only offer for trading purposes regulated stablecoins to their European customers, and USDT is not part of those. For those here that are not that familiar with MiCA and what this means for stablecoins availability and usage in Europe, basically MiCA determines whether a stablecoin is regulated or unregulated based on the category its issuer is put in, a category that depends on the nature and location of reserves, mainly, not only, that are backing the stablecoins themselves. So since March already, several exchanges, including OKX, Kraken, and Binance, have announced that USDT won't be part anymore of some of their product offerings, including spot trading for some of those exchanges that I mentioned, to Europeans specifically. So we can expect the stablecoin market structure to change slightly in the coming months, depending on listings initiatives by exchanges like those mentioned before, enabling them to stay compliant in Europe. So I'm going to finish with a last example on Binance. So on Binance, we have seen FDUSDT stablecoin being the largest stablecoin by volume on the platform. So this was led by its zero fee strategy. Of course, European volume isn't probably much of that. But even MiCA regulation should have an impact on that structure you see on the screen. Binance won't be able typically anymore to enable zero fee trading to as many customers as before for any stablecoin, specifically the unregulated ones. And MiCA itself seems to inspire other regions. So stablecoin issuers will probably need to adapt in order to stay competitive with respect to those like Circle, whose bet is being amongst the first regulated stablecoins in regions where regulation is already established, like Europe.
Great, thank you. So now I'm going to take a bit of a step back to look at a report that Kaiko publishes every quarter. For about 2 years, we have done a cryptocurrency exchange ranking. And our goal with this ranking is really to provide a very neutral, systematic way to assess cryptocurrency exchanges. We believe that it's very important in the industry for a neutral provider to do something like this. And essentially traders, regulators, researchers, they can leverage this ranking to essentially perform a benchmark of the exchanges that they're either using or looking into. But most importantly, we have this ranking to incentivize good behavior. We've actually noticed improvements over the past couple years. We have a lot of contacts with exchanges. They've reached out and they really want to improve their rankings. And so this is a powerful motivator to do so. So here are the results of our Q2 2024 exchange ranking. We include almost 50 exchanges in total, but here I have just taken a screenshot of the top 10, but you can find the full ranking on our website. So our ranking incorporates 6 different categories that we use to assess each exchange. We look at governance, security, liquidity, data quality, technology, and business. And within each of these categories, we have additional measures, sometimes quite a few, that are used to essentially create a score for each. And then we aggregate it into the Kaiko exchange score. The highest score will have the highest rank. And then we'll also provide a letter grade. So even if you have maybe not a high score, you might still be relatively well off and earn an A rank. So some of the stats that we picked for this exchange ranking this quarter was, first, that Coinbase for the 10th quarter in a row holds the top spot. So this is really demonstrates Coinbase's commitment to good governance. They're a very liquid exchange. They work very closely with regulators. And I think they've always ensured that their technology and business is really at the top of the game. So it's really no surprise that Coinbase holds the top spot. Some surprising stuff, though, are stuff like Binance US, and improved 5 places this quarter. I think a good example of how the exchange ranking sort of motivates exchanges is that while Binance US has had many regulatory problems in the past, they have started to clean up their act. And in fact, they now have very good rankings for things like governance and security. And actually, the one thing that they don't rank well on is liquidity. This is because after all of the regulatory challenges, they saw a lot of traders leave the platform. Some other stuff that we noticed is the Latin American exchange Bitso earned its first A rank. This is sort of interesting considering we're doing a big deep dive on the Latin American region, which we'll publish tomorrow. And then finally, we still are very strict with certain exchanges that do not have good governance or KYC. And for example, the exchange MiCA, they failed to qualify for any rank this quarter due to poor scores in these categories. So now we're going to dive into the liquidity component of our exchange ranking. Liquidity is particularly interesting from a research perspective, but also from traders. Typically, traders are looking for the most liquid exchange. So in this chart, we take all exchanges that are included in the ranking and we rank them by their liquidity score. So the lower the liquidity score, the better the liquidity. And you can see here that not like some exchanges that were not in the top 10 are actually in the top 10 when just looking at liquidity. The biggest example of this is Bybit. Bybit is not in the top 10, but ranks second in terms of liquidity. This is because they have very high trade volume and market depth, and they're sort of known as like the less regulated but widely used exchange, especially in APAC. We can also see here that even though Binance does not rank first on our exchange ranking, they do in fact rank first when looking just at liquidity. And the reason that is you can see in this chart, now we're actually diving into the raw data that is used in our exchange ranking. Binance by far has the top trade volume out of the top 10 exchanges. So here we're now again looking at just the top 10 exchanges for our ranking. Binance has more than $700 billion in monthly trade volume on average over the previous 3 months. In fact, this is 7 times greater than its closest competitor. In the previous quarter, Upbit had very, very high trade volumes. They saw a surge in volume, which was a bit abnormal, but it's since actually fallen quite a bit. So I don't think we'll be seeing Upbit again next quarter as a top 10 exchange by volume. But they still managed to surpass Coinbase. I think this might have been the first time they did this on a quarterly basis, which also shows and demonstrates that South Korea still has a pretty active crypto audience. So now if we look at a slightly different way to understand the exchanges in our ranking, some exchanges have a strategy of listing many different crypto assets. So here we have plotted the number of active crypto assets on the exchange relative to the average monthly trade volume. So you can see at the bottom right that HTX, formerly Huobi, has more than 600 listed assets. It has by far the most assets listed out of the top 10 exchanges. However, its volume does not rank very highly. So this shows that the number of listed assets doesn't always correlate with higher volume. And it actually maybe signals a more lenient listing policy, whereas exchanges like Coinbase or Gemini or CBOE, they have a very strict listing policy. For example, they're probably not going to list any random meme coin that is popular. They're going to really pay attention to the markets that they're adding to ensure that there's strong liquidity, which ultimately better protects traders. But overall, we see a slightly linear correlation excluding HTX. Binance does have the second most assets, and it also has by far the highest trade volume out of our top 10 exchanges. So if you're interested in learning more about our exchange ranking, we also produced a big exchange ranking report. This is live on our website, and I'll send it in the chat right after. And so now I will pass the mic to Desi, who will take a look at regional crypto markets.
Thanks, Clara. So I'll be talking about regional market trends. We know that the volumes on crypto exchanges generally went down in Q2, and this was due to several factors, macro headwinds. Adam mentioned as well the slowdown in ETF inflows. So what we have here is the first chart, which shows the fiat volume share for the top 15 fiat currencies. We see that the Korean won, as Clara mentioned, did outperform in the first quarter of the year. It actually surpassed the dollar as the top fiat currency by market share. However, since the start of April, it has actually been losing market share, and its market share is now down to its lowest level since the start of the rally in October. There is a lot happening also with smaller fiat markets, and we'll see this later. The Turkish lira actually surpassed the euro as the third largest fiat currency by market share. But let's move to the next chart, which essentially shows the volumes on the 4 big Korean exchanges. We see that volumes have absolutely collapsed in Q2. For the 4 exchanges you see here, volumes are currently at around 6 billion, which is a roughly 80% decline relative to the average for Q1, which was around 35 billion. And the decline has been driven by Upbit, the largest Korean market. Upbit has been facing strong competition, domestic competition from BitHump, and typically its volumes, essentially for all Korean exchanges, are mostly driven by small cap altcoins, which are very move with risk sentiment. The next chart shows the Korean market relative to other exchanges, namely Japanese exchanges. I wanted to talk a bit about Japan. Japan is one of the oldest markets in crypto. We know that Mt. Gox is one of the, which was one of the biggest exchanges, is actually a Japanese-based exchange. However, volumes on Japanese markets have been very low. We see, however, that since October, since the start of the rally, the share of the Japanese exchanges has increased from 6 to 14%. This is quite a significant increase relative to Korean markets. And one of the reasons for this is that they are very much driven by Bitcoin, and Bitcoin has performed pretty well. The next chart, yes, shows the market share of volume by asset in this year. Of Korean and Japanese exchanges, we essentially see that these markets are very different when it comes to risk tolerance, and this has also been shaped by regulation, because we know that asset listings are very strictly regulated in Japan. Korean markets are driven by small cap altcoins. The top 10 here include all the top 10 altcoins, excluding Bitcoin and Ethereum and excluding stablecoins. We see that Japanese exchanges are actually driven by Bitcoin trading. One interesting note is that since 2020, we see that the share of small cap altcoins in Korea is rising, which means that traders are actually taking more risk. And the same goes for Japanese markets, where the share of Ethereum has increased pretty significantly this year. Next, zooming on Turkish markets, opposite to the Korean won, the Turkish lira actually hit an all-time high in market share of volume. And as we see on this chart, which shows the Turkish lira exchange rate versus the dollar and the Turkish lira market share, it has been very correlated with currency weakening. The Turkish lira hit very recently another all-time high against the dollar. We know that inflation there has been very high at around 70%. And we also see that political uncertainty has also been correlated with rising crypto volumes. Something similar is happening in LATAM, and this is the last chart, which shows the monthly volume for the main LATAM currencies, the Brazilian real, Argentinian peso, Mexican peso, and Colombian peso. We see that volumes have been rising quite significantly. They're currently around 2 billion. And the one interesting takeaway from this chart is that Binance, which is the largest exchange, still has actually been losing market share to local exchanges such as Mercado and Bitso, and its market share has fallen below 50%. So with this, I'm going to leave the floor to questions.
Great, thank you very much. So now we'll take time to answer some questions. So feel free to add them directly in the chat or using the question tool. So I'll start first from Adam. If USDT is going to be removed from Kraken and Binance, what is the impact? What will be the stable coins that increase in adoption instead? So Anastasia, do you want to take this question?
Yes. So for sure, Kraken and OKX are gonna delist all the Euro slash USDT pairs that has been already announced. And I think, and by checking what else is available, I think USDC will actually take the volume that USDT Euro pairs were taking before, since with DAI, at least on Kraken, is the only offering that those exchanges have currently against the euro. So also given that USDC is actually considered as a regulated stablecoin, so at least according to Circle's announcement on the efforts that they're going to make it like a regulated under MiCA, I think it's going to be the one that will be taking over the volume that Europeans have been initiating with respect to USDT. And when it comes to the consequences and the impact for the users actually already holding USDT in Europe on exchanges, I think there is no impact. Like, they still are going to be able to transfer this on-chain or swap it to other cryptocurrencies. So yeah, those two things could be the consequences of that, like until June 30th.
Thank you. So now we'll have a question about our exchange ranking from Patrick. So he asked, how do you assess exchange security? So we have our full methodology on the webpage that I sent you. The Kaiko research team, we handle the liquidity component. So we'll do our best to answer other non-liquidity questions. I believe that we use security certificates, which should be made public for the exchange to assess their commitment to like audits and security. We have another question on exchange rankings from Gabriella. How come you add HTX even though Huobi has been fined to fake their volumes and the FCA added them to the list of unlicensed crypto companies to avoid? So that's a really good question. So we do our best to be as data-driven as possible. We definitely do take this into account in computing the score. So with HTX, they have high liquidity. They rank highly in quite a few things. And because we have a purely neutral data-driven approach, even though they have been added to these lists, they definitely get penalized, but it still like leaves them in the top 10. So you can see all of the individual scores for HTX if you go to the webpage, and you can filter on the various like governance, liquidity, security to sort of understand where HTX ranks on all of these. But it is a good question. We're aware that it's not a perfect ranking, and that there will always be some like issues with how it's computed. Okay, next question from Patrick. Are you able to localize some of the DEX volume to complete your regional analyses? Maybe I'll let Anastasia, our former DeFi product manager, handle that.
Unfortunately, no. So DEX volume is totally pseudonymous. So we do have the addresses, but we don't know where it's located. On centralized exchanges, we do locate by fiat currency that is traded. A way to actually locate would be to cross information on like the IP addresses that are used for each trade, but we are specialized in market data and we don't cross that type of information in order to provide information on the localization of each trade happening on DEXs.
Great. Do we have any more questions? And one more note. So for liquidity, we also take into account market quality. It's one of the sub measures that we include in the global liquidity measure. So we are trying to keep into account artificial volume, although this is very hard to detect on some platforms just due to the level of sophistication that the bad actors are doing. So we are aware of the issue. It's been a very big problem in crypto. And we are also looking at measures such as the exchange's policy on market manipulation and wash trading, and if they are implementing measures to prevent this on their platform. Okay. So you can find a recording of the session on our website in a few minutes. And other than that, thank you very much. Our next call will be in September. And please reach out at research@kaiko.com if you have any further questions about our research. We publish our newsletters, which I'm sure you guys are all already receiving. Thank you very much.